Hello, and welcome to today's video. Public debt, a topic that concerns many people. Especially in times of economic challenges, the question arises as to how far governments are allowed to go into debt, and what the impact this has on their citizens and the economy. It can ruin you down as a citizen that your country's politicians are not good with money. Let's start with a little fictional story. Once upon a time, there was a small country called Astoria that was struggling with financial challenges. The government had spent more than it had taken in, so it had to go into debt to finance public spending. But instead of slowly reducing the debt, the government kept increasing the debt by borrowing more and more. One day, the government decided to build a new airport to boost the country's economy. It took out a huge loan from an international bank and started building the airport. But it soon turned out that the construction was more expensive than expected, and the government had to take out more loans to cover the costs. When Astoria's economy went into recession, tax revenues fell, and the government could no longer afford the interests and repayments on the debts. The international banks that had loaned the money raised the interest rates, and Astoria's debt continued to grow. The Astoria government was now in a dangerous position. It had accumulated too much public debt and could no longer service it. The company was stagnating, and the country was forced to turn to international organizations for more loans, which demanded harsh austerity measures and reforms. Astoria was now trapped in a vicious cycle in which ever-increasing debt created ever-increasing costs, and the government was forced to take unpopular measures to reduce the debt. The country's citizens suffered the effects, and it took many years for the country to get back on its feet. The Astoria story shows that public debt can be dangerous when it gets out of control, and why it may very well affect you directly when your country's debt goes up. It is a complex issue that has many facets and cannot be reduced to simple answers. But what exactly is meant by public debt, and how is it monitored? What factors determine the limits of debt, and how do they affect the economy? And what happens when the debt burden becomes too large? In this video, we take an in-depth look at public debt and examine the various aspects that affect it. From legal and economic limits to political considerations in cases of high debt, we cover it all to give a complete picture of the topic. Why is the issue of sovereign public debt relevant? The issue of sovereign public debt is relevant because it impacts a wide range of areas, including the economy, the financial sector, the political landscape, and people's daily lives. Public debt can have both positive and negative effects on the economy. A high debt burden can lead to higher interest rates, which increases the cost of government and can affect public spending. Public debt also has implications for the financial sector, particularly the stability of the banking sector. If a government cannot meet its obligations, this can lead to a crisis in the financial sector. Public debt can also have political implications, particularly with respect to a sovereign's ability to meet its policy objectives and commitments. Finally, public debt can also have an impact on people's daily lives, especially in terms of public services and social benefits, and thus on the quality of life in society. What does public debt mean? Public debt refers to a government's debts incurred through the issuance of government bonds and other liabilities. This debt is used to finance public spending, such as investments in infrastructure projects, social services, or defense. Thus, a government may incur debt when its expenditures are higher than its revenues. It can also happen that a government wants to raise its debt to overcome a crisis or to make a major investment. The public debt is then bought by investors who trust the government to repay it. Therefore, public debt is not automatically negative, but sometimes even helpful to finance important public projects or programs. But when the debt becomes too high and the government's ability to meet its obligations is called into question, it can lead to economic problems. If you like this video, we appreciate a thumbs up and that you subscribe to our channel. What are legal limits? Although there are no universally accepted legal limits on public debt, many countries have laws and agreements that govern how public debt is handled. These laws and agreements can help increase economic stability and prevent debts from spiraling out of control. Some countries have set legal caps on public debt that limit the level of debt a government can incur. For example, a law may provide that the ratio of debt to gross domestic product, GDP, cannot exceed a certain percentage. This can help to keep a government's debt burden manageable and preserve the government's ability to repay its debt. In other countries, debt-raising agreements may exist to regulate the handling of public debt. These agreements may specify certain requirements for debt incurrence and use. For example, an agreement may stipulate that debt may only be incurred for certain purposes, such as investment in infrastructure or education. What are the economic limits? A high public debt can cause investors and lenders to have concerns about whether a government will be able to repay its debt. This can lead to an increase in interest rates on debt, making it more expensive for the government to take on new debt and repay existing debt. High debt can also cause investors to become uncertain and lose confidence in a government's economy, which can lead to a slowdown in economic growth and higher unemployment. However, low public debt does not necessarily mean a strong economy. In some cases, low public debt can result in a state's inability to fund important public expenditures such as education, healthcare, and infrastructure. What are the political limits? An important political factor is government stability and approval. If a government is unstable or goes through a political crisis, this can cause investors and lenders to have concerns about whether a government will be able to repay its debt. Another political factor is political support for fiscal consolidation measures. To manage high public debt, governments need to be able to make policy decisions necessary to consolidate public finances. This may mean that governments have to cut spending or raise taxes to repay their debts. However, these measures may be politically unpopular and challenging to gain political support. Another important political factor is popular approval. High public debt can lead to governments being unable to finance important public spending, such as in education, health, and social services. This can lead to dissatisfaction among the population and political pressure. How is it possible for a state to incur debt? A government can incur debt by issuing bonds that can be purchased by investors and lenders. These bonds are debt investments issued by a government to raise money and must be repaid at a later date, along with interest. A sovereign may also incur debt by borrowing from other governments, international organizations, or multilateral financial institutions, such as the International Monetary Fund, IMF. Finally, a government can also incur debt by borrowing from banks or using lines of credit. These various methods of borrowing allow a government to obtain short-term financing to cover its expenses. However, this debt must also be repaid, which means that a state must organize its revenues and expenditures in a way that it is able to repay its debt. What are the procedures for monitoring public debt? In many countries, there is a national authority or ministry responsible for monitoring public debt. These bodies publish regular reports on the level and evolution of public debt. The European Union has adopted regulations that provide for the monitoring of public debt in the member states. These regulations aim to ensure a stable currency and a stable economy in the EU. International organizations such as the International Monetary Fund, IMF, and the World Bank monitor public debt worldwide and report on its development. Rating agencies such as Moody's and Standard & Poor's assess the creditworthiness of countries and evaluate their ability to repay their debts. These ratings can be an important indicator for monitoring public debt. Causes of high public debt. Japan has one of the highest levels of public debt in the world. In 2020, Japan's public debt was nearly 250% of gross domestic product, GDP. Despite its high level of public debt, Japan has been able to maintain low borrowing costs due to its reputation for financial stability and the willingness of domestic savers to buy government bonds. However, the country faces the challenge of balancing its aging population and social welfare needs with the needs to address its public debt. Greece has had a very high public debt in recent years. As part of an EU and IMF aid package, the country had to meet drastic austerity requirements to reduce its debt. The high levels of public debt in Greece were a result of a combination of factors, including mismanagement of public funds, a reliance on borrowing to finance government spending, and a lack of oversight and transparency in the financial sector. The austerity measures implemented by the Greek government have been met with resistance from its citizens, who have faced cuts to social services and higher taxes, leading to political instability and social unrest. USA. The USA has a high public debt, which is always a political issue. In 2020, the US public debt was over 130% of gross domestic product, GDP. The high level of public debt in the US is largely attributed to the country's large social welfare programs, defense spending, and tax cuts. While the US has been able to maintain its ability to borrow at low costs, the increasing debt burden and the political challenges of reducing spending and increasing revenue pose a significant challenge for the country's long-term economic stability. Italy also has a high public debt, which has steadily increased over the years. In 2020, Italy's public debt was nearly 160% of gross domestic product, GDP. The high level of public debt in Italy has been a source of concern for both domestic and international investors, as the country has historically been characterized by political instability and economic weakness. The Italian government has struggled to implement necessary structural reforms, and high public debts have limited its ability to stimulate the economy through fiscal policy. Often, this can be seen by a shift to the right or left in the government, accompanied by discrimination, exclusion, and tendencies toward a dictatorship. What are the consequences of high public debt for you? To service its debt, a government can raise taxes, which can be directly felt by individuals. A government can also cut public spending to control its debt, which can impact social security systems or other public services. High public debt can also hurt economic growth, which can lead to fewer jobs and a weaker economy in the long run. High inflation, which can also be caused by high public debt, can reduce the value of money, which can make it harder for individuals to maintain their savings. In conclusion, public debt is a complex and controversial issue that involves legal, economic, and political boundaries. Although it allows states to make necessary investments and overcome economic difficulties, high public debt can also have negative effects on the economy and the living conditions of citizens. However, public debt monitoring procedures can help prevent over-indebtedness and ensure sustainable financing. The issue of public debt remains an important challenge for governments around the world, and it will remain of importance to continue to monitor and discuss it. That was today's video on sovereign public debt and why you should react. Thank you for watching.